Hello and welcome everybody. Welcome to this XTB Trading Club. My name is Walid Koudmani, market analyst for XTB. And in this video, in this webinar, we're going to be focusing on the major topic these days, which is the US earnings season. What's been happening with the reports that we've been getting, how they've been affecting the stock market. And I'm going to try to explain to you a little bit of the fundamental factors happening right now in the markets. So of course, as always with these events, thank you everybody for being here. It's always a pleasure to host them. They are meant to be more interactive, so if you have any questions, please feel free to ask them. Not only that, but I will hold a question and answer section towards the end. So if maybe something is unclear, you can just write down the question. I'll try to get to it as soon as possible, or we can do it in the question and answer section at the end. We can even go take a look at some charts on the X station. So depending on what we're doing, we can take care of all of that. I have access to your comments here, so if you have any questions or comments, I can take a look at them on the chat here on the side. So if nothing else is holding us back, we can even start. So I'm sure many of you are here for the similar reason. So we're here to talk about some stocks and some indices and some the earnings season that's been happening. So this week has been centered around mega caps, meaning the biggest companies in the index, particularly the S&P and the NASDAQ. We had Microsoft a few days ago. We had Google a few days ago, Alphabet. And then we have today Apple and Amazon. So huge names could have a very big potential impact on the actual index itself. So if anything is unclear at any point, please let me know. If nothing else, we can just move on. So this presentation, of course, is provided for general information and marketing purposes only. Any opinions, analysis, or other content does not constitute investment advice or recommendation. We're just here to give you educational content, help you understand the markets, and make the most informed decisions you can. So let's start with some top news. We're going to go a bit of an overview of what's been happening in the markets, why things are moving the way they are, and how they relate to each other. So we saw the central banks become a bigger and bigger topic and bigger focus of markets lately. Of course, traditionally not that much, but these days it seems like even announcements have seen an impact on the market. So Powell, who is the president or the chairman of the Fed, so the US central bank, signaled a possible rate hike in 2022, but market reaction was short-lived to that. So markets have been reacting to even comments such as this, but at the same time, the more this happened, the more they become priced in the indices. And if you followed other webinars we've done in the past, you'll have seen that a lot of the valuations of these stocks and these indices is not necessarily tied to their performance, to their price, to their price, to their earnings, or to anything like that. So that's the interesting part, is a lot of these central bankers are having an impact on them because they are the ones really sustaining that market. The lira, if any of you trade the Turkish lira or tumbled after a deep rate cut and another diplomatic rift where President Erdogan fired some more people. Evergrande, which was the headline story for quite some time, is the Chinese developer who was on the brink of collapse and defaulting on their debt, which would have probably led to a chain reaction and domino effect across the markets. That was really the biggest story for maybe a week or two. A couple of weeks ago, about a month ago, they were about to default on their debt. They were giving a 30-day extension, and then past that, it looks like that situation is being resolved. They are going to be focusing more on their EV business. Some key events this week have been IFOs from Germany on Monday, Conference Board on Tuesday, US, Bank of Canada decision the other day, Wednesday, so yesterday. Today we had US GDP, which was below expectations. We had German inflation, which was at the highest level in 30 years since 1993. And then we have the Bank of Japan decision as well, along with the ECB conference and ECB decision as well. So we had the European Central Bank today decide to leave rates unchanged. We saw a quite marked reaction in the euro, but that also might be led by some weakness in the dollar, which we're going to be taking a look at in the charts in a second. Again, thank you everybody for being here. If anybody has any questions, feel free to ask either now or later. We can have a question answer section where we take a look at the charts or anything like that. As always, my name is Walid Koudmani, market analyst for XTB. And yeah, thank you everybody who... Oh, the picture is a bit blurry. Is this picture like the image on the right, I assume? Or is it my picture? I am hearing a comment that, or I'm reading a comment that the picture is blurry. Is it my image or is it the image on the screen itself? Because if it's that, I can just read that out. Anyway, so we have earnings season on top of everything happening. Tomorrow, US inflation, and we saw some really big earnings this week. Indices at record levels, even today. US 100, if you follow the news section on the X station, you'll have seen reached a new record high. And we have S&P also at new record highs. But is it an effect of buybacks? So a lot of these reports, earning reports, if you've been following them, in the headlines and even in, let's say, in the outlines of what they've done, might not be the top. But you'll see that a lot of these companies are issuing a lot of buybacks on their shares to really boost the prices of their shares in a sense. We recently indicated that despite numerous long-term threats, the recent small correction has probably already been completed. In a very short time, the S&P has achieved a new record. Interestingly, there was no groundbreaking news or events behind this move. And Goldman Sachs points out that companies will make record purchase of their own shares this year. So that's the one thing that we can keep an eye on moving into the final quarter of the year with these share prices, is how many shares and how many companies are announcing share buybacks, because those could have an impact on obviously the price of the share themselves, because you're reducing the supply in the market, then affecting the. Thank you Douglas for the clarification on the chart. Hopefully the other ones will be a little bit more clear. If not, I'll just read what's written on them and hopefully that will help. So here you can see U.S. share buyback authorization announcement through October 8th in billions, 884, almost reaching $1 trillion. So obviously much higher than previously, about as high or almost as high as 2018 was almost as high. And then we have to go back to all the way to 2007, right before the crash almost. And that's when the highest level was. Interesting to note, and interesting thing to keep an eye on moving forward. We also have huge inflows of funds with very cheap cash with the low interest rates into the stock markets. I've talked about this in many webinars and videos, where a lot of the money that was getting basically printed into the market was going back into the stock market, not necessarily into production. And we have Goldman Sachs pointing out that share buyback is responsible for the largest marginal effect of net demand in the last decade. If we add to this the huge inflow of funds this year, including the effects of checks and other handouts, as well as the huge excess liquidity generated by the Fed, whether through QE or low interest rates, then we have a recipe for an unbalanced market. And this is really something that I've been saying, ever since the beginning of the pandemic, almost, with the reaction of the central banks, that, everything had to lead to something at the end. This is, we're approaching the final stretch here. In addition, interestingly, Goldman Sachs analysts believe that the argument for a strong quarter are worse prospects for 2022. In other words, perhaps this is the last chance to take a bullish stance on the indices, because the economy probably is going to continue to recover with the reopening and all of that. But as we've pointed out in the past, positive economic performance is not necessarily related to the price of the shares or the price of the index. In fact, nowadays it's actually the opposite, which is interesting, because you would assume that the economy is doing better. You would assume that stocks and shares are going to be doing better, in particular indices. But actually the case is probably the opposite, because a positive performance from the economy right now would signal to the central banks to change their monetary and fiscal policy. That's what's really keeping markets and investors on the edge, is the fact that at any moment this excess liquidity, which, as I'm pointing out here, has been flooding into the stock market, could stop. So therefore, all this inflated value, which is really out of excess liquidity, would then probably be readjusted in some way, because you would have these valuations not comparing to their market valuations anymore, and then you don't have all this extra cash. That's when you might have a real adjustment of the index itself. But this is at a point where obviously we would have to have some serious changes in fiscal policy, monetary policy, and so on, which, as I pointed out in the beginning, the Federal Reserve's pointed out it's not going to be happening probably until the beginning of next year. If anything is unclear, as I said, please feel free to stop me, ask me questions, or anything like that. We also have this chart here. Excess liquidity will not budge. One thing is certain, the over liquidity on the market will not budge, since the record sum of money has nowhere to go. One should expect a bigger downward movement. But really the headline and what we're here to talk about today, mainly I'm going to touch on some commodities at the end, because the energy market in particular does have an impact on these kinds of things, especially the indices, companies, as you might assume. But what have we been doing with what's been happening with the earnings season in Wall Street? So the first 2 weeks of Wall Street earnings season did not bring really any surprises. The results were better than expected. The dynamics were distributed by low base effect from Q3 2020. So that's the thing, is we're comparing back to a year ago, which was September, or basically Q3 of 2020, which was right after the first reopening, let's say, and that is a very strange or a very difficult period to compare to because it was such a unique circumstance that now anything you compare to it almost is going to look amazing. But it's important to point out that we have had positive results for a lot of these companies. While the first week was dominated by banks and financial institutions as usual, the reports were more mixed in the second week. However, one could find a common denominator in the publication, which is supply problems. Supply problems, which I've talked about, we've talked about, if you follow the news section, if you follow the WhatsApps, I've mentioned this many times, is that supply problems are really tying into a lot of the markets and a lot of industries. We're going to touch on them later on as well, but the main thing is that it's a cycle. So once one part of the cycle is starting to suffer, you'll find effects across. So let's say there are supply problems, that leads to shortages, that leads to higher prices, which then leads to even more complications down the line. So it's a cycle that kind of feeds itself. Intel pointed out to component shortages as a risk to semiconductor manufacturing. That's been a headline where semiconductors, which are used in chips, they're used in cars, they're used in computers, they're used in so many different technological things. There's a shortage of those. There has been really from the pandemic. We've been hearing about companies starting new factories, but that's going to be a slow process, let's say. Tesla pointed to record profits and sales, but also pointed to the risks of semiconductor shortages, as I mentioned. IBM drew attention to the rising labor costs and possible problems with transferring them to customers. So again, as you can see, they're all tied together. And Snap pointed out that supply chain problems make companies less likely to advertise because they're unable to meet demand. So you can see how many different factors or how many different effects one factor can have, where supply chain problems can impact all this side of the businesses, where it's all on the supply and being able to actually provide the goods, which you would think we're trying to sell as much as possible, but we actually can't provide. Even there, if there is demand, we can't provide. So this is a situation where we haven't found ourselves in yet as of late. But as you can see, a lot of the positive performances were met with caution and also, be aware of the future as these supply chain and costs could then impact. In addition, here we have this week's calendar. So most of it is done. Today we still have Apple and Amazon. So we are going to go take a look at the charts for those before the earnings release to take a look and see what happens. But besides that, we can see that there was Facebook on Monday, Microsoft Alphabet / Google, Visa on Tuesday, Coca-Cola, McDonald's on Wednesday. Today, as I said, Apple, Amazon, MasterCard. And Friday, we have Exxon and Chevron. This week, more than 160 companies from the S&P index will publish their results. 19 of them have capitalization over $150 billion. The mega caps will be crucial. Facebook, Microsoft, Apple, Amazon. These are the ones that really go and impact. Although Tesla has become one of those as well at this point. For Alphabet and Facebook, the focus will be on ads, especially after Snap's warning. Because most of their income, of course, is from that. In the Apple report, investors will be looking for comments on the lack of semiconductors and the impact of production, and the impact on production, sorry. And from Amazon, comments on supply chain problems will be crucial in the case of Amazon's performance. So for today's reports, in particular, Apple and Amazon, look out for these factors potentially impacting the prices or impacting their forecasts, really, because even forecasts could impact the prices of these shares. As we move on, I'll show you what the situation is like on the charts right before the earnings get released. Besides that, obviously, we had this positive performance from the other stocks this week, which, as you can see, this week, even today, US 100, so the NASDAQ reaching new all-time highs, the S&P pushing higher. European indices slowing down a little bit, but as you saw today, there was some general positive moves in the markets. Now, the main fear happening at the moment, or really taking markets, their focus, is the fear of inflation. So the rising prices, the devaluing of the currency, those are the main issues at the moment attacking these stocks prices, really, and the investors that are following these stocks are really focusing on these things. But one of the main things to notice is that if you look back to the 1970s and 80s, when inflation CPI was around 12% and then almost 15%, markets at this moment are no longer worried of inflation, even though the risk seems to be higher than in the spring. So can investors take any lessons from the history? The important thing is that for a long time, throughout this basically the pandemic, the Fed, the central banks, even today the European Central Bank said that inflation is going to be transitory, meaning temporary. So it's going to be a thing that's going to fade away on its own, and at the end of it, basically they will adjust without them having to intervene in an earlier than expected. But what can we learn from this? It turns out that we need to go back as far back as 50 years. There was a Nifty 50 rally in the 60s, and even though inflation spiked in the early 70s, it took a few years for equities to realize. Indeed, the first rise of inflation can be really seen as temporary. That's the real point of view to keep an eye on here. But where do we hide against inflation? So obviously, again, this is not investment advice. This is the general performance of several assets, and we can analyze what's been happening. Now, this doesn't count crypto, which is, in my opinion, important. Obviously, in the UK, it's a different story. There is no crypto. But at the same time, it's important to keep an eye on that investors and people in general, they do traditionally look for a cover from inflation, meaning that, let's say, there is always going to be inflation of some level, which is why they have a target. So let's say the target is 2%, and the inflation target is 2%. We've met that target. That means every year prices are 2% higher on average, or roughly it means that your currency, whatever $1 or £1 or €1 you used to buy, you can buy 2% less with that dollar or whatever that currency might be. Again, so if anything is unclear, please stop me or please ask a question, or we'll do a question and answer section at the end where I'll be able to answer your questions, look at the charts, and so on and so forth. But in the meantime, let's keep looking here. So the important thing is that with the cover from inflation, traditionally investors can do several things. So if you keep your money in the bank, let's say the bank's interest rate is, 0.1%, then obviously you're not keeping up with inflation, because £1,000 or $1,000 a year later, they're worth 2% less, and you've made 0.1%. So obviously it doesn't work out. But what has been the performance so far in the last 50 years, or at least in the 70s, as you can see here? The decade of the 70s presents some interesting observations when there was this very high inflation. So what were investors looking at the time? Gold is definitely the best at that time. It has never been negative in real terms. Ultimately, its purchasing power has increased 4 times. Silver is doing well, although it has had a powerful drawdown. Paradoxically, deposits and bonds have retained their purchasing value. Stocks, initially they were great. In the end, they were the worst. However, we should add that cash really is the real loss, which would be about 50%. So that's the moral of the story here, is that whatever you did at that time, cash was the worst option. If you bought stocks when inflation was high, and then you sold at the end when inflation was low, then also that showed negative returns. So that's the important part to pay attention to. How the cycle repeats when inflation is very high, or what we can expect when inflation is high, because history might not repeat itself, but sometimes it rhymes, as they say. So when patterns form in the past, investors have not changed them from that end. We just have more ways to counter inflation or to cover ourselves against inflation, let's say. So nowadays you have, let's say, property investments, you have cryptos, you have gold, you have silver, you have ETFs, you have so many different ways, long-term holdings, short-term holdings, trading stocks, there's so many ways to do it. And investors are choosing their ways. But in the 70s, when we had that record inflation here, as you can see, between 1970 to 1980 in the US, this was the performance of assets. Of course, gold was king at the time, and that's really the main point to take out here. However, and this is the disclaimer, that does not mean that the current decade will be the same. Above all, in the 70s, the Fed actually tried to protect the real value of the dollar. In January 1970, the effective Fed rate exceeded 9%. And the 5-year bond yield was 8%. The Fed could afford it. Government debt was 35% of GDP, while currently it is 125%. Therefore, even if inflation is lower, bonds and deposits are almost guaranteed to lose the value of money in real terms. The 1970s saw the departure of the gold standard in 1971 by the USA, which had a significant positive impact on the price of the metal. Therefore, it should not be blindly assumed that in conditions of high inflation, gold must gain similarly. So let's step back here from those and take a look at the context that we were mentioning earlier. So while in the 1970s, this was the situation where you can see bonds really performed quite negatively, the S&P really performed quite negatively, except for the beginning. We have cash, which has really performed negatively from start to finish, and then we have gold, silver, and bonds potentially doing decently. So that was the situation. But now we have a different situation where gold is no longer that sort of, it's no longer tied to the dollar. There is no longer that spike, which it got after it got decoupled. We have a GDP or a debt that is 125% of GDP for the US. We have a very, very different fundamental situation. Shares were initially less overvalued than they are now as well, based on price, earnings over price, and GDP ratios. And the dividend yield was much higher. Finally, economics and markets are not physics. The two situations are never the same. Very important to keep an eye on. Now, what else is really impacting these stocks before we move on to the charts and take a look at Amazon and Apple in particular? Really, the commodity market, ironically. Maybe some of you might not really fully understand why that might be, but at the same time, you just have to go and look at the news headlines we've been getting in these past few weeks related to the energy crisis, potentially at one point kind of in a reality at some other points, but it definitely is affecting a lot of aspects of the market. So we've had rising oil prices, record nat gas prices, even record oil prices for a few years, and these are commodities that are actually consumed in a day-to-day life and function, whether you travel for work with a car, or you travel for work, or you want to travel with a plane, or you ship goods across the world with container ships or with planes. This is all going to add into the costs for your final product, leading into what we were talking about at the beginning with these rising costs and applying onto consumers. Because if I'm the business owner and it's costing me twice as much to ship something, I can't have that cost be all on me, because at that point I have an issue where I'm at loss. The consumer is paying the same, but even they at some point are going to have issues with the economy, with the energy market, because they have uses in their own daily life. So this is going to affect everybody from top to bottom, the energy market, whether you're a supplier, whether you're a consumer, whether you're a producer, whatever you are, and you're using energy, this is affecting you. So therefore, this then goes to affect stocks and indices as a result. That's what I'm trying to get to. Now, oil, let's talk about some fundamental factors for oil. WTI reached $85 per barrel earlier this week for the first time since late 2014. Goldman Sachs still expects oil demand to rise to above 100 million barrels per day and shift from natural gas to oil to contribute at least 1 million barrels in additional to daily demand. Saudi Aramco warned that global spare supplies of oil are falling quickly and companies need to boost investment into new projects. Impact of a coup in Sudan on total OPEC plus oil output is expected to be limited. Sudan is a member of the broad OPEC plus group. Now, oil stockpiles remained flat last week and are sitting at near 5-year low for the current period. Saudi Aramco warns that the lack of new investment projects in previous years has led to a very tight supply situation, with additional capacity being very limited. Now, this is one side of the story. Important thing to note is that OPEC did meet a couple of weeks ago where they decided to maintain and actually you can check out our other YouTube video on the commodity special we did about a month ago or a few weeks ago, where I mentioned this, that OPEC had agreed to increase production by 400,000 barrels every month, but there was a potential that they would increase it more to contend with the rising oil prices. They didn't do that, but it was stated at the time that they did have excess capacity and they did have excess supply. So it was a choice. Now we're running into a situation where global stockpiles are running lower and lower. So even if they were to want to increase supplies, we're having an issue where there might not be those supplies anymore, impacting potentially price. Hopefully, again, everything is clear until now. Thank you everybody who's been with us so far. Don't worry, we're going to get to a question and answer section very shortly. And for anybody who's wondering, my name is Walid Koudmani, market analyst for XTB. And this is a XTB trading club dedicated to the stock market, dedicated to taking a look at the market's overview, and dedicated to really the earnings season ongoing, with today's Apple and Amazon earnings in focus, as they are the two mega caps. But we are covering all aspects of the markets because they all do impact each other. So this is something that is always worth keeping an eye on. Furthermore, on oil, so here you can see the inventories. Here you can see Russian Deputy Prime Minister Novak said that he wants OPEC to stick with its current policy of increasing daily output by 400,000 barrels per month. Saudi Arabia said that OPEC needs to be cautious when increasing supply not to flood the world with oil, with the risk of while risk of economic slowdown remains. And oil stockpiles at Cushing, Oklahoma are dropped to the lowest level since late 2018. So these are important points because, as you can see, they kind of, let's say, contradict what Aramco's saying here. Because here they're saying they want supplies to remain the same in production, but here they're saying that we're running low of spare supplies. So as you can see, the price is not necessarily naturally growing because the supplies are there. They're just choosing not to release them in fear of a potential economic slowdown for like further lockdowns or something like that, and that could then impact, let's say, the long-term price of oil. But it's important to pay attention to that because at the same time, if there were really a shortage, the situation could change. So it remains to be seen. But we also have this chart here on the right with oil WTI on the 4-hour chart, where you can see oil pulling back from a 7-year high reached earlier the week near $85. Note the local market geometries have been respected by the price throughout the ongoing 2-month upward move. So you can see this upward move, pullback, test, upward move, pullback, test, and we're testing this red line right here for a long time. And then, but really it's quite a symmetrical move where it moves up, pulls back, and then moves back up again. Now we're moving and pulling back. We're probably looking towards this area as a potential support as it acted in the past, but past performance does not equal future results, of course. And then finally, the last really energy market impacting the stocks has been nat gas. So natural gas prices, especially if in the UK, you've heard that a lot of energy companies actually failed and actually went bankrupt because they couldn't provide their services anymore. So definitely something worth following. Natural gas prices resumed upward move after a brief correction. Nat gas jumped more than 20% over the past week and climbed back above the $6 or the $6 mark. And the interesting part is that what we saw was both nat gas and oil spiking for the past few weeks, and then we saw nat gas have a huge correction, but then nat gas continued to move upwards again. According to data from the TSO, net flows of Russian gas to Europe through Ukraine and Poland dropped to the lowest level since January 2020, which is important to note because just what really helped with this temporarily was the announcement that Russia was going to be supplying more nat gas to Europe. Another factor that adds to the tightness of European gas supply is the situation in Norway, where maintenances and technical problems lowered output at some gas fields. And this is really what I like about commodity markets, in particular oil and nat gas, is the supply and demand really dynamic that you can clearly see is visible, whether it's because sometimes you have storms in the US that shut down oil rigs, then you can see that there's a supply shortage on that end, and you can kind of infer what's going to happen on the prices, or that at least there's going to be some sort of reaction on the price. Similar situation here. Below average temperatures are expected in the United Kingdom and Western Europe in the coming days, which may lead to an increase in demand for natural gas. Again, further stressing the supplies. Flows of Russian gas to Europe through Ukraine and Poland dropped to the lowest level since early 2020, combined with outages on Norway gas fields. The situation adds to already tight supply. So again, these are issues that could be impacting markets in the coming days moving forward. Keep an eye out for the energy market and how it might impact not just obviously the prices, but then how it could have a larger impact on the overall stock market and sentiment. And that's it for the presentation. Really quite a short one on the presentation side. But we can move now to the question and answer section. So if you have any questions, please feel free to ask them in the chat. I'll try to get to them as soon as possible. And whether it's regarding a stock, another market that you're interested in, or earnings season, as we mentioned here, whatever is your interest, I have the chart here on my side, and I have the comment section. So if you have any questions, please feel free to ask them in the chat. Also, if you enjoyed this video so far, please feel free to leave a like, subscribe to the channel, and follow us on our social media on Instagram, Twitter, Facebook, and so on. Besides that, yeah, so if you have any questions, hopefully the chat delay isn't too long, but I'm conscious of it, that there is a chat delay. So I'll just wait a couple of minutes for some questions. Again, thank you very much for being here with me so far. My name is Walid Koudmani, market analyst for XTB. And yeah, let's move on to some charts. I even have the X station ready, so if we want to take a look at some actual price action, we can do that as well. A reminder that today Apple and Amazon are releasing after the market close their earnings, so keep an eye out for that. that's going to be something worth keeping an eye on. And as I said, the focus for Apple will be comments on semiconductors because that has been the headline, while for supply chain problems, or for Amazon, it'll be supply chain problems. But yeah, so if anybody has any questions, please feel free to ask them in the chat. I'm looking at the chat right now just to see if there are any questions, and just to see if anything was unclear, perhaps. So far, as I said, the first 2 weeks of earnings season have been good. Did not bring any surprises, but the dynamics were disturbed by low base effect from Q3. So let's see. I think there is a slight delay, of course, but I'm just awaiting some questions. If it's any questions related to anything we talked about today. Okay, good question. Douglas asks, why did the UK budget have such a positive effect? So, I'm assuming you're implying a positive effect on the stocks. So let's go ahead and take a look at that. Let's go take a look at this. So UK 100. This is, let's go back to Thursday. Rather Wednesday. So as you can see, the budget was actually released yesterday. And this is the situation today. Now, traditionally, the announcement of spending is potentially a good thing because it allows, let's say, if any of you have followed the UK budget announcement, there was a lot of announcements of tax cuts, tax increases, budgets shifting, some sort of stamp duties, tax reliefs, budget allocations for social programs, let's say building as well, the NHS. There was a lot of detail in that report or in that announcement. But the important thing is that the question then at the end of all of that, so let's take everything good about the budget, and then at the end, the question always remains is how are you going to pay for it? And that's really the uncertainty that comes into the markets. Now, important to note that, we also have had similar performance, not so bad with a gap, but a similar performance on other European indices as well. So it hasn't only been the UK index. But yes, so Girish asks, thank you, Philip, for the compliment. It's always a pleasure. And again, if anybody has any questions, feel free to ask. So Girish asks, what do you expect for the FTSE 100 to do over the next few months? Now, important. This is an excellent question. And it kind of ties into what we were talking about with Douglas's question. So why did the UK budget have such a positive effect? So in the immediate, it could have a positive effect. But let's take a look at the index on the next few months scale. So let's go on the daily chart. So I'm assuming the next few months, let's say until the end of the year. So let's say until December. So time to draw some lines. First of all, let's draw some potential support and potential resistance. So maybe these seem to be some important levels to keep an eye on. Now, we have broken past this previous high. So as you can see, this area has been tested 3 times as a high. 1, 2, 3, 4th time, there's a break. Important thing is that the break was followed by a retest. So now that this area was a resistance in the past, is now acting as a support. The lower area here is a potential support on the longer term, but around 7,000. So it's funny how you see that I can draw the lines almost immediately randomly, or at least visually, let's say, but it almost always lands on some sort of psychological level that is like 7,000, 7,100, 7,200. It's interesting. It's partly coincidence, partly psychological. That's why they're called psychological levels. Now, if we were to keep draw a trend line on the daily chart for, let's say, the FTSE 100, touching, let's say, 3 points at least, so maybe 1, 2, 3 with this, you can see that now we're about to test the trend line. We are actually testing it right now. It is going to be important to see what happens moving forward with the index, as in, does it keep its trend line? Does it stay above this potential support, or does it pull back into this range? And then we would have to test this area as a resistance again to see what would happen. Now, last time, you can see every time it drops below it, you see a small pullback, testing the lower limit, except for here with a potential double top, which was followed by this huge drop to 6,700 points. Now, for the next few months, there could be a scenario where we see a potential increase where this area keeps getting tested and positive performance, and especially obviously if the central bank stays with its policy. On the other hand, if we see any sort of big changes from the central bank, we could see an even bigger reaction in the stock market. Maybe not as much as US indices. So with the focus on that, let's say I think that, this is my opinion, I think that the effect of a change in policy from the US on US stocks is going to be probably bigger than the effect that the UK stocks have when the UK bank changes its policy. Doesn't mean they're not going to have an effect. It's probably going to be significant. But these are the factors that are important to keep an eye on. So once we draw trend lines, once we draw some, let's say, ranges, now we know roughly where we're trading. We keep an eye out for that. We keep an eye out for the trend line. We keep an eye out for the support and resistance levels. And as I mentioned in the previous webinar that I did with the XTB account manager, Reed, you can go and watch that on YouTube. We mentioned the fact that there are certain risk factors for markets. So it's not necessarily one thing that can impact the whole market. There are a certain number of risk factors that are going to be impacting the market. So whether it's the central bank, whether it's supply shortages, obviously there could impact the market, whether it's a rise in COVID cases again, which could lead to lockdown or something like that. All of these things can then go and impact the market. And if there's one thing we learned from the pandemic is that this could be shooting up to here, and then something could happen that could drop it, 50%. But obviously, traditionally speaking, blow off tops are not necessarily something that is sustained. Okay. Hopefully that answers your question. Obviously, I can't give investment advice, and we don't predict the future necessarily, but it is, give yourself all the advantages you can, give yourself all the info you need. Don't overwhelm yourself. Have a few averages. I like price action. I think that is one of the easiest ways. So by that, I mean just looking at the charts, seeing what the price is doing. It'll lay itself out. The formations will be there. And once you see them, you'll start to notice, like, why is it that this same place gets tested 3 times, and then the 4th time it goes up, and then it becomes a support? Maybe we don't give reasons to why this happens, but it is important to notice that this does happen. And we can go and look at example after example of areas throughout the charts where the same thing seems to happen over the distance of time. And that's the important part, is that it has to be after some time to be tested again. Thank you for that question. So Douglas asks again, what effect will an interest rate rise have? So excellent question. Interest rates, so what are interest rates really? So interest rates is the costs of borrowing money from the central bank, which is then transferred onto normal banks, retail banks, which is then transferred onto consumers. And also the interest rate is what you would get if you were to deposit money and save money with a bank. So let's say the interest rate is 1%, which it is not, but let's say it is. So for every £100 you deposit in the bank, at the end of the year, you get £1 back. Conversely, for every £100 you borrow from a bank, at the end of the year, you have to give £1 back on top of it. So you give 101, and then on the reverse, you get 101. Now, why is this important? Because if it is very cheap to borrow money, then people do it more frequently, obviously. And if that borrowed money then becomes more expensive, then people save more money because it is more beneficial to save money rather than to borrow money, because I get a higher interest rate from basically saving my money rather than paying a higher interest rate on borrowing. So what happens is with higher interest rate, liquidity in general drops in the market. So cash drops in the market. As I've mentioned in the slides, a lot of this cash has been going into the stock market, not necessarily the actual economy. So what you can assume can happen is that potentially with a change, which in this case would be a raise or an increase in the interest rate. So now I think it's at 0.1% for the UK. Let's say they change it to 0.5%. That's almost 4 times as high. That's going to be noticeable, and that's going to be having an impact on the money and the cash supply in the market that then goes and impacts the stocks. So let's say there is, 20% less cash in the market. That means that whatever allocation that was having prior, that is going to be probably either redistributed or removed entirely from those sectors. Hopefully that clarifies it. So really, in essence, an interest rate increase just means less cash in the market, an interest rate because saving is more convenient and also borrowing is more expensive. Conversely, the opposite is true, or vice versa. When interest rates are lower, it's cheaper to borrow but not as convenient to save, as we've mentioned earlier. That's the point, that now if you put your money in the bank, you're getting 0 interest rate. So basically, if you do anything else with it, almost better. Thinking the market, Douglas says he thinks the markets are high on cheap borrowed money. Definitely, definitely a possibility. Rather, that's the theory that we've been discussing. That's something that I've talked about for now almost a year and a half on this channel and on the news that we do. That's the theory that we've been discussing, basically, that a lot of this excess liquidity in the market has been pumped into the, well, we saw it go into crypto at the beginning of the year, at the beginning of this year. Some of it, we saw this huge influx with the stimulus checks, particularly in Dogecoin. But besides that, a lot of it has been going into stocks. And a lot of the money that we're really talking about is big money. We're not talking about really the small checks necessarily, where like it's $1,000 or $2,000 or whatever you get for check going into that. It's really the institutional money where it's like you're borrowing $100 million and then that's cheaper. That's when it matters, not necessarily on 1,000 or 2,000. But yes, so when that borrowed money basically through an interest rate hike becomes more expensive to get, that's going to be the interesting moment where we see what happens to the stock market. I'm sure many companies will do fine. I'm sure many companies are healthy. But as we've pointed out in the past in another webinar that I've done, and I forget the name of it, but it was relating to the stock market, and we talked about the weighting of the index, how the S&P 500, for example, is an index that everybody knows, I assume. And if you look at the companies in the index, you'll see that, for example, Apple, Amazon, Tesla, Google, the top 10 or top 20 companies make up the 80% almost of the weight of the index, which means that when those companies move, they move the index. When 80% of the other companies have to move the index, basically. So you see what the proportion is so skewed to these tech companies, essentially, except for maybe Tesla, even though that's a tech company on some level. The weighting is so skewed on those levels that anybody buying their stock is driving the price of the whole index up. That, you see what I mean? So when that money is out of the market, perhaps we could see some reactions in the markets moving forward from that. But let's take a quick look. Also, if anybody else has any questions, feel free to ask them in the chat. Whether it's you want me to go back to a slide we covered or it's about a market we are talking about right now. Let's go and take a look at the charts for Apple and Amazon right before today. So today, Amazon, after market close, we have the earnings report. As I said, keep an eye out for the earnings report from Amazon, and also keep an eye out for anything they mention on supply shortages, because that's really something that, and also, of course, rising fuel prices also impact Amazon. So at the moment, Amazon price slightly down from the highs, but you can see, as I mentioned, keep an eye out for these levels that get tested several times. This is on an hourly chart. On the hourly chart, where are we? $3,471 for one share. Now, let's narrow it down even further. We just broke through this level, which was a resistance in the past, a support here, even though there's a gap. We've closed that gap now, and we're back here. So essentially, we are now trading potentially, if this level holds, as a support, which, as a resistance, when it is overtaken, becomes a support if tested, if it holds. Now, if this holds as a support, then we are essentially back here in this range, very near to their all-time high. Now, if they do end up announcing a positive result, that could have an impact on the price of the share, of course. And also, if they do end up having a negative result, that could have a positive or a negative impact on an impact on the price. So really, it is determined by the reaction of the investors, how they see it. So if they see, for example, yeah, we've had a positive quarter, but we expect supply shortages, rising costs, labor shortages. We expect all these in the next quarter or in the next year. Then that's going to be more. There's more nuance than numbers at the moment. So it's not just about the numbers they've done, as I pointed out earlier in the slides with Tesla in particular, where they said, yeah, we've sold record numbers, but we have to contend with semiconductor shortages, we have to contend with supply issues, and we have to contend with rising costs of fuel because shipping our cars is becoming more expensive, so we have to build factories everywhere. And that's really what we're seeing at the moment here as well. So from a technical point of view, we are now potentially testing this area of 3,460. I want to draw it on the 60. And which, again, price reaction area in the past. I like to nowadays draw rectangles as, price reaction areas. As you can see here, throughout support, resistance, and now resistance or support. We have to see. But it's an interesting point to be at right before the earnings get released. Now, of course, this is a stock that gets, there's market close, so this is going to be after market close. But tomorrow is the final trading session of the week. So tomorrow could be a really interesting session for both Apple and Amazon. So this is Amazon. Hopefully, if anybody has any questions about the chart, feel free to ask. I'm kind of just going off of first instinct of what I'm seeing. Apple, on the other hand, similar situation, but better than Tesla. So now, another high. You can see here, previously broken. And then we're really close to 157. This is on the daily, though, so that's important to keep an eye on. And you can see that for the past few days, so let's say since the beginning of October, almost, this is the beginning of October, the share price is up over 10% on this steady upward move with a few hiccups here and there. What we had really was, we had the announcement of the new phone and then some sideways movement from Apple. It's going to be important to keep an eye out for today's earnings report because, as I said, not only will their performance be impacted by these supply shortages or semiconductor shortages, but we need to see the projections coming up for the next year now that the new iPhone has been launched and announced. So as far as the share price is concerned, let's go on the hourly just in case. You can see a lot of sideways trading here throughout the week. And then just today, breaking past this level at 150, now forming potentially a small flag, as you can see. But still not quite at the highs of 157, but we're getting there. And it's going to be important to see if this price keeps moving up, even though you can see the upward move is quite strong. So traditionally, it is important to keep an eye out for a potential retest or something like that, or if the price is going to continue to move forward. But let's see where it did stop. Why did it stop here? So let's draw a horizontal line and take a look at what is happening. You can see previous support, resistance, resistance. It's an interesting thing to note, as I pointed out earlier, how, we can draw a line here without even looking at the past, but then we go and see why has this been support. So potentially this could be an area to keep an eye on as we await for the earnings release. Will the price move higher? Will it pull back? Will it just move sideways here? It will be determined by that and some other factors as well. So this is just a general overview on the stocks. If anybody else has any more questions, feel free to ask. We'll take a couple more, maybe 10 more minutes, and then we'll call it a day. I don't want to keep you too long here. There is some trading to be done. So yeah, thank you everybody who's stayed with us so far. Again, my name is Walid Koudmani, market analyst for XTB. If you enjoyed the video so far, feel free to leave a like, subscribe, and I'm always looking forward to new topics that we talk about. This obviously today was focused on the stock market, the mega caps, the earnings, which have been having a huge impact on investors, as I said. So conscious of the time delay, I'm just awaiting some questions in the chat. Thank you very much, Douglas, for asking them. Girish, Philip, and everybody else who's asked questions today. So as always, thank you very much. So the questions can be about this market or any other market that's interesting or that interests you. So feel free to ask and I'll try to answer. I have the chat here. That's why I'm looking to the side. But yeah, let's take a look at. So we also have an actual new report here on, if you're interested, on by a stock of the week, Microsoft, with an outline of their results from this week. But what we saw was results for calendar were no exception. This company beat sales and earnings forecast for the 11th straight quarter. Revenue climbed 22% year on year. Although, as I mentioned, it's important to notice that last year it was Q3 of 2020, so the pandemic. to 45 billion and 32. Douglas says he thinks an interesting week is coming up. Absolutely. So it's been really interesting every week, to be honest. You know, the summer tends to be sometimes slow, but we're picking up now, moving into September, October. All markets really have been moving. So let's take a look at let's just take a look at an overview and see what's happening. So we have UK 100 testing, recent highs. We have Euro USD, which I forgot to mention actually, but as you can see, huge move on Euro USD today. This is today on the hourly chart. Past this sideways move, an upward move of 0.8%, and now trading at 116.8, approaching 117. So broke through this trading range and then this trading range, and then now is slightly pulling back, but we will have to wait to see if this area gets tested as a potential support or not, or if the move continues to go even higher. But yeah, any other questions? Feel free, don't be shy. I can talk about any other market that is interesting to you or that you might be following. But yeah, Euro USD. But you can see that I like to have the overlaid US dollar index chart on top of it. So that's something worth noting, is that these blue candles are the US dollar index, pulling back quite significantly, almost mirroring the move. Although the euro is slightly stronger, we also did have, as I said, the European Central Bank decision today. As widely expected, they decided to not change their interest rates, but there is a potential for a change in their pandemic purchasing program, and that could have an impact on the markets as well. So looking at the questions here, just waiting for a couple more questions. And if nobody else has any, of course, we can just finish the webinar. It's okay. I'll just wait for maybe like one or two more, and then we can move on. Oil, let's take a look at oil prices real quick. Pulling back, now trading around 83 on Brent, while WTI, see this huge spike on the weekly. It's going to be an interesting week to see where it closes. Let's take a look on the daily. Daily, quite negative today for oil as well. Thank you, Douglas. Enjoy. Yes, of course, go feed your dogs. Thank you very much for being here with us. And I look forward to seeing you in the next event, where hopefully we'll be talking about something just as interesting as today. So thank you very much for being here. I guess if that's it, nobody else has any questions, I'll just end the webinar here. Thank you to everybody who stayed with us, and hopefully this was useful to you. I like to give a general overview. Correlations make you understand how markets affect each other, why it's worth paying attention to the news, and what we keep an eye out for the charts. So if you're in the WhatsApp group, or if you're not in the WhatsApp group, where I send market news, alerts, and updates throughout the day on, I could send like a level and something's happening, feel free to contact your account manager. They'll be happy to add you. If you enjoyed this video, feel free to leave a like, subscribe to the channel. You can check out our other webinars as well. I've done several others. We have another one from last week you can check out. You can also look at, of course, our social media pages with Facebook, Instagram, Twitter, and if anything else, of course, feel free to get in contact with your account manager. Nothing else. Thank you very much, everybody. Thank you for being here with us. My name is Walid Koudmani, market analyst for XTB, and I'll see you all at the next event. Good luck with your trading. Thank you.